What's up everyone, it's Karthik with MoneyVest. So welcome on board for another Market Open live stream. So we do have the markets pushing higher. Pre-market, we're seeing a little bit of a bounce. Just think about what was the case, what was the situation this time last week. So Monday at 8:30 a.m. Eastern, we already know what was going on. It was quite a crazy and wild start to the week. And of course, the markets were down, I think a little bit over 2.5%, close to 3% on Monday. Recovered a little bit on Tuesday, down again on Wednesday, and then Thursday, Friday was very strong, especially Thursday. We recovered to basically close flat on the week here. And so far, Monday morning today, QQQ's up almost 40 basis points. We've got SPY up over 29, almost 30 basis points, and Tesla flat, Nvidia up a little bit over 1.3%. Volatility here coming back down to as low as 20.48. But this right here was the situation on Monday morning last week. Exactly this time last week, we were at over 80. We were at over 65, up over 180% from those low levels of 15, 16. So it's been definitely quite an eventful week. Last week, we had a lot to go over. It was, very, very wild in terms of volatility, a lot of data points to break out. But this week is no different. We do have CPI numbers, so inflation numbers are going to be coming out. And Mike says, good morning. Can you believe it was only 1 week ago? Yeah, I mean, it's crazy. Kind of feels like last week felt like a really, really long week. So that's why that spike seems a little bit farther away. But it was only 1 week ago. And last week, like I said, was seemed like a really long week because, not only do we have a lot to talk about, we also did have a lot of market volatility, a lot of buying opportunities in my opinion. And only time will tell, of course, if you do see another spike here in the VIX, if you do get up to, over 30 or 35 or 40 levels again. But either way, I think that's going to represent even better buying opportunities for us once again. So if the audio and the video is good, just give me a thumbs up. I just want to make sure that there are no technical difficulties. But we are back down in the 20s for volatility. Individual stocks are pre-market higher. So if I include for the extended hours here, you'll notice a majority of stocks are pushing up pre-market. So let me just bring that up here. Okay, so starting with a few companies. So starting with Magnificent 7, we got Google here, just flat. Meta's flat. Tesla's flat. Apple is up 23 basis points. Netflix is up 30 basis points. We got Microsoft up over 60 basis points. AMD 78 basis points. Amazon's up 72 basis points. And Nvidia is the only one that is up a little bit over 1.3%. Starting with some of the other companies that are up a lot. You take a look at Digital Turbine up over 2.2%, Starbucks up 2.5%, Robinhood's up 2%, Zim Integrated's up almost 1.7%, and we got FNGU up over 1.6%. This was one of my trades from last week, and it is up very, very nicely. As you can see, that it's up a little bit over 37% from its lows of Monday morning last week here. And Palantir also getting up to over $30. I did a video on Palantir last week, so make sure that you do check out that video. I picked up shares Monday morning, of course, at $21, $22 where it opened, and since that level, it is up almost 40%. So that was a clear buying opportunity. That was the Monday morning breakdown, trading as low as $20, $21. And I think it was really, really important to buy in and around those levels for majority of stocks that were trading at significant discounts to their historical highs. And those were some levels that we don't necessarily need to go crazy on because volatility spike was a bit of an overreaction from the market, as we discussed in our previous videos, that the VIX getting up to over 65 is a clear overreaction because the market's drawdown was less than 10%. So you don't necessarily see a 180% spike in the VIX when the S&P is only down 9%. The more appropriate level was in the 20 to 30 levels, which is exactly where we are at the moment. So Ryo LaCap asking, do you think it will stay in the 20s or it'll go back to the teens? It's anybody's guess at the moment, but if you really do take a look at the VIX terms futures, we are in contango towards the back half of the curve. But in the front two contracts, which is M1 and M2, M1 being the August contracts expiring in 11 days or 10 days, I believe, and the September contract, they are still in backwardation, meaning the M1 contract is priced higher than the M2 contract, but they're both below the spot VIX value, meaning that they are not expected to increase above the spot VIX, which is at over 20.5. That is the current VIX value. So at expiration, every contract moves closer and closer to the spot VIX, depending on whether it's higher or lower. So right now, since we are seeing the M1 contract price lower, the market is not anticipating any volatility spike anymore. However, around October time, markets are pricing in for another spike here in volatility, which makes sense because September, October more specifically has historically been a pretty wild month for the market seasonality wise, and November has been the best month for the market. November and December, more specifically Q4, has been the best time for the markets from a bullish perspective. But Q3 has almost always been a pretty volatile and brutal quarter, I should say, for the markets, because September is the worst month, with October coming in with the most bottoms we've seen for markets have formed in October. Last few years, if I really just go over S&P 500, you will see a very clear pattern that it's most likely bottomed in October. So if you go over to the weekly time frame, what you'll notice is over here, this right here was October 2023. So last year we saw October 23 as the bottom for the market. This right here was September, October of 2022. Another really, really nice bottom for the market. Let's see if we can figure out some other trends. This right here was another dip in October of 2022 before, of course, ripping to new all-time highs. Come back a little bit further. This right here is, so October was basically the starting of that pullback. So 2018 was one of those times where Q4 was pretty brutal. I still remember I was actually in school. We were studying about the US-China trade war back then in 2018, as I still literally remember this is like a fresh memory for me, where we were talking about the market sell-off in 2018. I graduated in 2019. So in 2018, we were talking about the US-China trade war in one of my finance classes, and we saw the markets drop into a bear market, over 20%. So that right there, we bottomed around December 2018, of course, 2019 being a very solid year. And then if you come back a little bit further, let's see if we can spot some more times. This right here, August, September, again, being one of those times where the markets bottomed. And then, of course, another January time where they bottomed and pushed higher. So there's been some seasonality aspect to the entire market in the past, and September being one of the worst months, if not the worst month for the market. In fact, I did some analysis on seasonality over my weekend video, which kind of goes over all the seasonality trends for the market going back as far as 1900s. So this was the overall analysis since going back as far as 1900s from a seasonality perspective, which essentially goes over different months and at what the average return has been and what is the probability of that month being higher or lower. So what you'll notice is a few observations that I was able to come up with is November is a month that has only gotten better over time, especially after 1975. So 1975, prior to 1975, November was just another month which was up like 1% on average, 63% probability that it's going to be green, 1.83% since 1950s, with a 69% probability that it's going to be green, and post 1975, we've seen a 73% probability. It was almost identical to December with an average gain of over 2%. And since 2000s, since I've been born, we have seen a 75% probability for November to be higher. So November month has really just taken off in more recent times. November and December both have over a 70% probability for them to be green months. And in a few summer months like April and May, really those are months prior to summer that are also very, very strong. April more specifically, I think, comes in as the second best month after November since 2000. We've seen a 1.66% gain with over a 72% probability for us to see momentum to the upside. And of course, September being the worst month, and it's only gotten worse since 1900. In more recent times, we've seen since 1975 with an average loss of almost 1%, and it's only gotten worse since 2000, down over 1.65% on average over the last 23 years, and with only a 45% probability for it to be higher. So 55% probability that we're going to be seeing red in the month of September for the markets. If you come over to the monthly time frame, let's take a look at the last few months, last few Septembers. This right here was September 2023. Markets down almost 5%. That is a pretty significant loss. September 2022, also another brutal year of September, down over 9%. And then if you come over to September 2021, down again, almost 5%. So we've got a 100% hit rate for the last 3 years in September. September's only coming up in 2 weeks, 2.5 weeks left for September to begin. And the last 3 Septembers have been pretty brutal, down anywhere from 4 to as much as 9% for the markets. If you go over to, wow, September 2020, down almost 4%. So that's 4 years in a row. September's been pretty brutal. And 2019, September was slightly up 1.7%. But prior to that, October 2018 was pretty bad, almost 7% down. September was still holding up well. And then we've got September 2017, we were up almost 2%. So 4 out of the last 4 years, September has been brutal for the markets. So that is some seasonality to take into account going into this September here. Okay, so coming back over to some of the comments. By the way, we've got pretty muted chat here. If you guys are joining us, let me know in the live chat where you're tuning from and what kind of questions you have with respect to markets, macros, fundamentals, technicals. We'll come to individual stocks towards later in the live stream, but I really want to start us off with the current market environment, the current market structure, volatility, macros, technicals, and keep it more geared towards the overall market here. So let me know where you're joining us from, what city, what state, and hope you're doing great this fine Monday morning. Of course, this time last week was a pretty panic mode for the entire market, volatility up over 180%. And this Monday morning is a bit more calm as we kind of ease into the market here after the weekend. Volatility is back in the 20s as markets are seeing some more momentum higher with, of course, individual stocks pushing up. QQQ's up over 30 basis points. We got the SPY up over 25 basis points. Tesla's basically flat. Nvidia pushing up 1.3%. But I'm really paying attention to a few leveraged ETFs like FNGU, for example. It is up over 1% pre-market, so back up to 348. And I'm also watching SOXL, which is another ETF that I'm considering from a trading perspective. So we're going to be watching that as well. Have you done a video on ZIM? Yes, I have done several videos on ZIM integrated shipping. We talked about how that is a big delusion when it comes to their dividend yield. We talked about ZIM integrated shipping paying out dividends based off of their earnings and profit. And as the shipping rates come down and normalize post-pandemic, as supply chains ease up, they're not going to be able to keep up with that profit, and eventually they're going to realize a lot of dividend cuts, and there could be some massive exodus out of ZIM integrated shipping from investors that are mostly investing in that company for the sake of dividends. And that's exactly what happened as shipping rates came down, profitability struggled, the company actually went into a loss, dividends got cut, and ZIM is down, I believe, over 70-80% from its all-time highs. Although recovering a little bit, recovering quite a bit from its lows of $6.70, $7 a share. From its all-time highs of $44, still down almost 60%. At one point, it was down over 85% from its all-time highs. So it has done a pretty decent job in recovering back up. And dividend yield is more normalized now to 1.26%, with some quarterly profits now coming back in for the company. Okay, although I just bought Palantir towards the end of the day last Monday because I had issues in Saxo to fund my account, as many other people had issues with their brokers. I'm proud I took part in history, so that's good, Vault. And yes, I really want you guys to, pat yourself in the back if you were able to take advantage on last week's sell-off as volatility peaked out at over 65, because that was a historical moment, because we haven't seen volatility as high as it is since the pandemic, and this was the third largest increase in volatility in the last 33 years. But if you go back as far as 1987 and the Black Monday crash of 1987, this was the fourth largest increase in volatility since 1987. So if you look at 2024 minus 1987, we're going back as far as 37 years, and we're seeing the fourth largest spike in volatility. So if you were able to take advantage of that rally in volatility, and of course that drawdown in the markets, definitely do pat yourself in the back, because you took part in history buying Monday morning. Okay, so you already covered that question. Palantir $35 this week. Let's go. So Alex says, yep, it's possible. I wouldn't bet on it, but yes, it is possible. And we calculated some streaks for individual stocks. I'm going to continue to do these types of analysis because you guys seem to absolutely love these types of breakdowns. So let me see if I can bring up my spreadsheet on Palantir. Let's see. Palantir. Yeah, I can't seem to find it. But what we really went over, let me see if I can pull it up here. Yeah, the problem is that it was still a CSV file, so I wasn't able to save it. I might have to do that analysis again, but we looked at the historical streaks for Palantir. We are in, I believe, over the 90th percentile for pricing wise for Palantir, and I think the longest streak, I forgot for Palantir exactly how many days we've seen for Palantir to be consecutively green. But that type of analysis becomes very useful as the stock keeps going higher and higher, because at some point, as it's going higher and higher, the probability for us to see more green diminishes over time, because at some point we're going to see a bit of a pullback for individual stocks, right? That's how the markets function. They go up, they come down, and that's the overall trend. Okay, so we got Vladimir from Boston. Shout out to Vladimir. I love Boston. Been there a couple times. In fact, lived there for a couple of years. Absolutely in love with Boston. One of my favorite cities, if not the favorite city in the U.S. Louisiana, not doing my job. The market is more important. Bangkok, Thailand. You got road trip. Correct me if I'm wrong. Is that Sea Falls or is that, how do you pronounce that? I'm so sorry. Georgia, we got UK in the house, Italy, South Africa. So yeah, let me know where you guys are joining us from. London, good morning from Boston. So a couple people from Boston here. Again, thanks so much, you guys, for joining in. Uruguay, waiting for the CPI. So we got Sydney. And yeah, CPI is going to come out on August 14th. So we've got Wednesday. Wednesday, I'll be live earlier to go over CPI numbers. Again, we did a full analysis on US CPI. So that was on a different spreadsheet. I broke it down in my other video. Yeah, there we go. So this is the XLS file that we broke down. So this was the CPI video. I highly recommend that you check it out. Gives you a bit of an idea of what the numbers are right now. So we're right now sitting at 2.97% as of June. And depending on what we see for a month-over-month change, this right here is going to be those expected numbers moving forward. And really where we want to operate is either see no inflation or actually start seeing deflation in order for us to come down closer to the Fed's target of under 2%. So the only way we actually come down closer to the Fed's target over the next 12 months or so is if we actually see some deflation coming in for CPI. And we saw that in the last report. On a seasonally adjusted basis, we saw a negative 0.1%. And that's exactly what we want to see, is for deflation to continue so that we can actually come down to 2%. And the Federal Reserve is going to be more open to the idea of rate cuts and a bit more aggressive to the idea of rate cuts. But at the same time, we don't really want to see negative interest rates, because that is actually going to be detrimental to the overall market, and the Federal Reserve's monetary policy is going to be very much against that. And this table shows you exactly when we are at risk of turning interest rates negative if inflation is moving on a different path. So if inflation continues to increase month over month by these numbers, 0.2, 0.3, 0.4, 0.5, so on and so forth, then with the current expectations for interest rates coming down, we are at risk of turning them negative. And this is simply based on inflation's path moving forward and interest rate expectations from the market. Those are the two things that I've combined here to better help you understand and show you what the Federal Reserve is not going to do. So they're not going to be, in my opinion, cutting interest rates so aggressively if inflation continues to increase by 0.2, 0.3, 0.4, 0.5% month over month. So they're going to be less open to the idea of interest rate cuts. Okay, let's see. So what's my view on Atlassian? So I actually do use Atlassian with my team. Well, sometimes we do, not always, but we have used it in the past. I don't think it's a profitable company yet. The ticker symbol is going to be TEAM for Atlassian. And so this right here is the company, and market cap just over 36 billion, and doesn't seem to be generating a profit as of yet. So losses coming in every year. It's got potential. It is a company that, in my opinion, in the tech world is very useful. Up almost 2,800% since 2016, but it's now coming down to that support again at 114. So that would be the level that I would be paying attention to very closely as a very strong area of support. So Caddy, on the stock streaks analysis, how about calculating the percentage increases in stock price versus number of consecutive positive negative days, especially for Palantir like stocks which are going up 10% plus a day? Yes, so the goal with that analysis was to really understand the overall streak so that people can take more informative decisions, whether you're trading options or just buying stock in general, because nothing goes up in a straight line, right? Nothing keeps going up forever. We go up, we come down, we go up, we come down. That's just the nature of the market. And I feel that type of analysis kind of helps us better plan for where I want to be selling calls or where I want to be selling puts. If you've seen, Palantir stock, for example, in the last 4.5 years since we've analyzed that company, let's say the longest winning streak for Palantir is 10 days. 10 days in a row. We've only seen that once. The Palantir's gone up consistently. It's been green. Now, of course, there will be anomalies, right? If it's happened in the past, doesn't mean it's going to happen again, but it's all a game of probabilities, right? Trading, investing is a game of probabilities. We're trying to assign probabilities of one outcome versus another. And again, if you do that over time, you'll see that you are going to come out on top. It's just like, gambling, right? So the house always wins because there's a hidden probability win for the house in almost every game out there. Apart from the skill game, which is, you could argue Texas Hold'em, if you're playing against the house, whether it's the roulette wheel or blackjack, the probability of winning is really low over time. You may win one hand or two hands, but over time, if you keep playing, you're going to eventually lose because the house always wins because they are just structured, those games, to win over time. That's the probability outcome. And that's what we try to do here at MoneyVest, is we try to analyze as much data as we possibly can so that we give ourselves the edge simply by understanding where the probabilities are for trading, for investing, for individual stocks. And that, again, very simple example I can give you right now. This is the most recent example is, why did we decide to buy FNGU on Monday, right? We picked up Monday morning, 258. And from those levels, it's already up a little bit over 35, 36% in just a matter of 5-6 days. Because it was a very precise calculated risk, probabilities made sense for us to take that trade because the Magnificent 7 index, as we like to calculate it, we understood that on average and on a median basis, we see a 19 to 23% decline from all-time highs after it being in a correction. Volatility spiked at over 65, which is already in the 99 percentile, very, very rare. MoneyVest index dropped down to 3, which was, again, a pretty low reading. So when you combine all these indicators together, it gives you that confidence that, okay, probability-wise, based on the numbers, based on the data and the analysis, it makes sense why we want to be a little bit more risk-on, be more aggressive, and we buy. Now, of course, things will fail over time because at the end of the day, it's still a probability, right? So if right now there is a 75% probability for a recession, the other side of the coin is there is a 25% probability for a soft landing. So you can make a case that 75% probability for a recession, so I better prepare for a recession, but you also have to prepare for that 25% outcome of not seeing a recession, right? So you have to be a little bit more balanced in your approach and not trade on just one direction or one outcome, because the other thing is also possible. So yes, but you're right. I think it's also important to also understand, what the percentage increase or the decrease is, and that's something that we can also look at, in the future. I agree with that. I love the analysis, but it'll help if it says Palantir went up 10 days in a row, only once with the stock going up 20%. Yeah, so we can incorporate those two things together with consecutive days as well as the percentage increase or decrease during those streaks to better understand, how much higher and how much longer can we expect that to continue. So that's a good point. So I mean, with data, there's unlimited opportunities. I mean, once you let your mind run, it can think about so many different things, right? And that's what I seem to like. It's not really a struggle, but it is a creative burnout at some point, because when I start thinking, right, and a lot of the ideas, believe it or not, I do think about this in my shower when I'm just like, how can I think about data in different sense? Like, what else can we come up with so much data that's already available to us, right? How can I, break things down in a different way, with combining it with volatility, combining it with recession cycles or the Federal Reserve and unemployment. So right now I'm kind of working with unemployment. And the interesting thing is, really what I want to show you is unemployment final. So this spreadsheet, what it shows you is going back as far as 1948. And it shows us the unemployment rate. So this is the unemployment rate for every single month going back as far as 1948. And what I want to do is I really want to understand, first of all, what percentile we're in. We already know that, 22 percentile, which is still low, right? So people freaking out on unemployment a couple weeks ago when it was at 4.3%. Yes, it is accelerating. So that is definitely something to take note of. But on an absolute basis, we're nowhere near close to even the median value. Median value of 5.5%. We're nowhere near close to that. We're still in the lower range of that percentile of 22%. So it is not a number to freak out of, right? Still within range. So that's why I was kind of dismissive of this idea that the Federal Reserve is going to come out and start doing an emergency cut, which many people seem to believe that, just because of the panic of volatility, markets coming down, the Federal Reserve is going to come out of there and they're going to start cutting rates emergency, right? There's a huge panic situation. I was like, I was kind of dismissive of that because we're nowhere near close to a situation where there needs to be an emergency cut. We're still pretty low on unemployment. Inflation is coming down, still under 3%. So there's no reason for the Federal Reserve to create this panic and come out and start cutting rates immediately. Now, what I'm really interested in is not the unemployment rate. I'm more interested in jobless claims. And the jobless claims are the most recent week over week data point that we can extrapolate and understand whether there is a recession signal or not. Because as you notice, if you come over to the initial claims, right, on TradingView, what you'll notice is that every recession we have seen a spike, right? And it spikes pretty high very, very quickly. So if I look at the recession and if I look at the jobless claims, unemployment is one of those indicators which is lagging after, meaning when there's a recession, if you combine recession with the cycle for unemployment rate spikes after we're already in a recession. But jobless claims is a little bit of a leading indicator because as jobless claims start to accelerate to the upside, then a recession follows because of just the nature of the frequency of the data. We're getting once a month report for unemployment, but we're getting 4 reports a month for unemployment claims, initial claims. So this is more about frequency of that data coming in more fresh, right? So we're getting every Thursday for the past week. And every time we've seen the jobless claims spike, a recession has followed. Now, the difference between unemployment and jobless claims is the participating population. So, the fact that this data goes back as far as 1948, and I've also got data for unemployment initial claims here, 1967. So we're going back as far as 1967. Now, when I was analyzing this data, the interesting thing was that we have seen a recession in the US when the peak in the jobless claims was as high as 300,000. It was at 300,000, and we were in recession because that was at one point a pretty big number because of the lower population size and lower participating population of workers in the US. So what we have to really do is we have to standardize all this data to better understand on a relative basis, is this number 233,000 high or low? Because in the past, 233,000 would already be a signal for recession because of the lower population size. But now, since the population has grown, since there's more people working, there's a bigger work pool, 233,000 is nothing. It's quite literally in the 17th percentile. So I'm working on this data set to divide this number with the total participating population, and then it's going to account for both the working pool and the current unemployment initial claims, and then give us a percentage. And then we'll look at that percentage and where we are relative to history, whether we're high, low, medium reading. And that as it accelerates higher, then we can have a much better, clear, smoother data set for recession. It's going to give us a much better signal. Okay. Anyway, I can go over that in a lot of detail because this is the stuff that does excite me a lot. It's just kind of analyzing things, in a sort of like a different sense. But yeah. So, okay. Are there any trading signals on the MoneyVest membership? So, again, it's just I alert people every time I'm making trades, whether it's options or investing trades. I like to be very clear that, you won't see me trade every day. It's not like I'm day trading or if I'm, sending out alerts every single day. I'm very specific and very precise in looking at market opportunities. And when a lot of things coincide together, like volatility spikes and the MoneyVest index is low, and my data essentially gives me the signal that, the risk reward is very favorable, that's when I send out alerts to everybody on Discord. So if you're expecting alerts every day or every week, then we may not be fit for you. But if you're looking for more higher quality, less quantity, but higher quality setups, and signals that actually do work, then yeah. If you have patience, to be trading in the markets, then yes, we can definitely help you with that. So have you tried using any AI tools that'll help with the analysis efficiency? Yes, I have been. I have been using it's kind of crazy because I have been using Bard and Meta AI to help me kind of create these data sets with Excel. So that's what I've been doing, is that I would use Meta AI to literally write the functions, write the formulas, so that I can expedite that process of just synthesizing all that data, because there's a lot of data sets. I mean, this is nothing. This is literally, how many rows are we talking here? 3,000. I've gone up to as much as 30,000 rows worth of data that I've analyzed. So Meta AI, Bard have been helping me kind of really aggregate all that data in a much more efficient way. Disney undervalued. Let's take a look at our platform, see what our platform is telling us. By the way, this is available. You can access this. All the members have access to this. So we've got a 2.98 rating on Walt Disney out of 5, which is okay, I guess. Anything over 3 is worth looking into. And anything over 4 definitely seems to be a bit more undervalued as well. So Jay, does your program includes any option trading recommendations or opportunity advice, or only for stocks trading? So yes, I do trade options as well, but I want to be very clear, I don't buy. So I'm not buying calls or puts. So if you are looking for trades or alerts for buying options, again, I don't do that. There's a lot of members in our community that may opt into buying options, but I only sell options. That's what I do. I sell calls, I sell puts, because the probability for success is significantly higher. I don't even remember the last time actually. Well, if you're selling options, you are just setting yourself up for success, because if you're doing them right, if you're doing them well, then it's really just a psychological loss. Other than that, on real paper terms, you are going to make money, because if you're selling calls, if the stock price comes down, of course that call is going to be out of the money. You're going to be profitable. If the stock rips through your strike price, then again, you get to keep the entire premium and you make money on the underlying position. If you're selling puts, then if the price goes up, then of course you're going further out of the money. You're going to be generating that premium 100%. And if the price actually pierces through your strike price and goes down, then even then, of course, you lower your cost basis. You get to keep the entire premium. Of course, you're going to be down on your underlying position, but that's the stock that I want to own anyway. I want to buy, so it's a win-win. So when I'm selling options, I am very careful in choosing the strike prices, picking expirations, and understanding the consequences of that. So yes, I don't buy them, but I do sell them. Notifications only membership tier. Yes, so there should be just one tier that's open that you should be able to join if you want to, and you will get everything from that. MoneyVest platform, Discord, Patreon, members only videos, everything. What's your take on Zoom stock? So Naman, you're a member, so you can actually check out the platform as well, on our platform. So let's just quickly go over to Disney first. Looks like in the last 3 years, the growth rate for revenue, 10.78%. We got revenue 5-year, 8.39%, and 10-year, 7% for revenue growth. So that's pretty decent, but earnings per share have struggled ever since after the pandemic, of course. Free cash flow is 10.8% over the last 3 years. And if you come over to analyst estimates, we've got a buy rating with forecasted earnings expectations growth of 43%. So that is actually really, really high for Disney. And revenue expected to increase by over 4.7, almost 5% for Disney as well. So those are some pretty strong growth rates from $1.29 to $7.73. So I think that's going to be going back up to where it used to be, because net income, of course, took a big hit for the company in the last several years. If you come over to 7 years worth of analysis, so you'll notice that they used to actually generate over 11 billion, 12.5 billion in net income. Then COVID hit, turned negative, and then of course we are now back up, but nowhere near close to what it used to be. So we're at 1.93 billion, 3.1 billion, 2.3 billion for Disney. So that's where we are. So yeah, if it accelerates higher, that is profitability, that is growth that Wall Street wants to see. I think it's really important for us to all remember that Wall Street is playing a very short-term game. Retail is playing a very long-term game. So that's a discrepancy that we'll always have. Wall Street is trying to hit their targets for the next few quarters, trying to beat the S&P 500 and generate alpha, meaning on a risk-adjusted basis, they want to see a higher rate of return. Whereas us retail investors, we may have a longer term view on the company that we want to hold on to because we see the long-term potential. And that's why you'll notice that Palantir for the longest time was not even close to any institutional investors' radar because it was A, an unprofitable company, B, lots of stock-based compensation, lots of dilution. So it was never really a company that made it on any Wall Street analyst's desk, right? It was one of the most hated stocks on Wall Street. And now more recently, you'll notice that there's been a lot of upgrades and analysts coming in and kind of getting warm around the idea of Palantir because of what? Only one thing. If you take a look at net income and how quickly they have turned the corner, if you go to the last 12 quarters, you can see that post 2022, the stock's been ripping, right? It's up over 300, 400%. Why? Because this is what they like to see. A lot of institutional investors, when they present their holdings to their investors don't want to see an unprofitable company that's not making any money. They want to see companies that are profitable, high quality, that are going to keep growing in the next few quarters when it comes to earnings. So that's why this is what they really like. And, if you take a look at, for example, 2024, June 30th, that's the Palantir's quarter, 135 million compared to what they did last June, 27 million, right? So that is an increase of 5x, right? 500% increase on a year-over-year basis, and that's incredible. And that's why Palantir stock's doing so well now. So that discrepancy will always create dislocations. So that's why oftentimes when stock prices are coming down based on incredible amounts of selling pressure from institutions, that may not necessarily mean the company is terrible, right? Just because the stock price is going down doesn't mean the company is terrible. And just because the price is going up doesn't mean the company is great. So those are two very different things, right? Price and the company are two very, very different things. Okay, let's see. JT, I'm low on cash. Do you think I should wait longer for stocks to fall more? That's a great question. I think I would refer to the liquidity framework that I did. It's a video I did over the weekend. Let me see if I can find that spreadsheet. There we go. So this is something that I talked about over the weekend. I feel like not a lot of people watched that video, but I think there's a tremendous amount of value that you can gain from that video. If you're ever asking yourself if you've got a lot of cash on the sidelines, if you've got, should I deploy? Should I buy more? Should I be more, patient with buying opportunities? So this is what I would recommend everyone. This is something that I would ask you to figure out for yourself because everyone's going to be different. If I ask you guys a question on the chat, where do you end up? Everyone's going to have different answers. But what we have here is two different liquidity frameworks. One is for your actual savings and your monthly expenses, and the other is for your cash in your portfolios for buying opportunities. So the red obviously means those are places you don't want to be in. The green is where I would preferably be in, but also there's a concept of overdoing it, right? So the first one is how many months worth of expenses do you want to have in liquid cash, right? Whether you want to have 1 month worth of expenses, 3 months, 6 months, 12 months, 24 months, or 36 months, right? That's the level of liquidity that you can keep aside if something were to go wrong. Unfortunately, if you were to lose your job or something happens, how many months can you cover yourself without having an income? So for me, I think 12 to 24 months is ideal, putting myself in a secure to robust position. And if I have 12 months worth of expenses covered or 24 months worth of expenses covered, that is robust planning that if something were to happen, at least I'm fine until I figure things out. So that is just for the sake of expenses. Now you come over to the portfolio, right? So everyone's got cash in their portfolio. If you're less than 0%, meaning you're taking on margin, that's going to put you in a bit of a distressed state of mind because if one time the markets drop 20% in a bear market, you are out of the market, right? You're going to get a margin call. Your stocks are going to be dropping like crazy and margin requirements going to increase and your broker is going to force you out of that market. So that puts you in a bit of a distressed situation. 0 to 5% cash is still going to put you in a vulnerable situation because you're not going to have a lot of cash. JT, looks like you might be in a vulnerable to a cautious place where you're 90 to 95% invested in the market. So that means you don't have a lot of cash and you might be asking yourself, like, is right now the right time to buy? And then you've got defensive 10 to 20%, prepared 20 to 30%, opportunistic 30 to 50%, but you don't want to be underinvested, right? That's why I mentioned you don't want to operate on the other extreme, right? So it's not like you have 0 months worth of savings, but you also don't want to have 5 years worth of savings. Then you've got too much cash and you're not really taking advantage of the market. Same thing here. You don't want to have no cash and take on margin, but you also don't want to have 60, 70% cash, right? Because then you're losing out on this huge opportunity cost. And with inflation, your purchasing power is going down. So it's really balancing the two and understanding where you're comfortable, most comfortable. I feel comfortable somewhere between 5 to as much as 30% in the cash in my brokerage account, and of course 12 to 24 months worth of cash in my savings for emergencies and if something were to happen. So those are the two places where I operate. But then you can also figure that out for yourself using these liquidity frameworks to better understand, okay, I feel comfortable with 12 months worth of savings and 10% cash, and that can fluctuate between 10 and 20 or 20 and 30 or 10 and 30. So you can figure that out for yourself and see, depending on the market conditions and where you're at with individual stocks and portfolio allocations, you can decide whether you want to put more money into the market or wait and be more patient. So hopefully that's a little bit more helpful. And again, a whole detailed video was already done on that previously. Okay. Rebecca, great value in the Discord. I'm newer to it and really appreciate all the support. So thank you so much. I appreciate that. And so we've got amazing people in there with lots of experience, more experience than me. I mean, they've been in the markets for several decades. So definitely it's been very helpful learning from everyone. So Mike, the options class is very good to help someone understand covered calls and cash puts. Highly recommended. So thank you so much, Mike. I really appreciate that. And yeah, if you want to access that, link's also going to be down below if you're interested. Your take on PayPal? It is holding well above $63 for a while now. Yeah, so PayPal has been unfortunately one of my worst stocks. It's just not done anything in the last several years that I've been holding this. It's been unfortunately a bit of a waste of capital being down so much. But yes, you're right. It's been holding up a little bit better. And we'll see. I mean, how Alex Chris kind of turns the company around, and if he's able to actually turn out to be a strong proposition for the long term with PayPal. But right now, as it stands, still down significantly from its all-time highs. I actually read, CEO Jeff Bezos's statement to its employees from back in 1999, actually from back in 2000s. And that was like one of the most enlightening and the most amazing things that I read in a long time. Let me see if I can pull that up. Memo to employees, 1999. So let me see. So this was the memo, which I feel was absolutely incredible. It's very well written. And so very well written, and really just goes to show how the price of the stock is not the company, right? There's a difference. So it was this. So what he says is to our shareholders, and this is from back in 2000 or back in 2000. Yeah, back in 2000. So this is what he wrote. This is Jeff Bezos back in 2000, writing to his own employees and shareholders. He says, ouch, it's been a brutal year for many in the capital markets and certainly for Amazon shareholders. As of this writing, our shares are down more than 80%. 80% from when I wrote you last year. Nevertheless, by almost any measure, Amazon, the company, is in a stronger position now than at any time in the past. We served 20 million customers in 2000, up from 14 million in 1999. Sales grew to 2.76 billion in 2000 from 1.64 billion in 1999. Just imagine, 2.76 billion for the entire year. Now that company does 2.7 billion per hour. It's absolutely wild. Pro forma operating loss shrank to 6% of sales, and that's down from 26%. Pro forma operating loss in the US shrank to 2%. That's down from 24%. Average spend per customer was up $134. Gross profit grew to $656 million. That's up from $291 million, 125% increase. International sales grew from 168 to 381 million. We helped our partners to sell more than $125 million worth of products. Ended 2000 with cash and marketable securities of 1.1 billion. That's up from 706 million. And lastly, this was the most important paragraph. He says, and most importantly, our heads down focus on the customer was reflected in the score of 84 on the American Customer Satisfaction Index. We are told this is the highest score ever recorded for a service company in any industry. So if the company is better positioned today than it was a year ago, why is the stock price so much lower than it was a year ago? As the famed investor Benjamin Graham, he quoted him, said, "In the short term, the stock market is a voting machine. In the long term, it's a weighing machine." Clearly, there was a lot of voting going on in the year 1999 and much less weighing. He says, "We're a company that wants to be weighed, and over time, we will be. Over the long term, all companies are. In the meantime, we have our heads down working to build a heavier and heavier company." So this hits so much. Like, it's his way of kind of articulating stuff and writing about it in 1999, kind of calming shareholders down about the 80% sell-off, which is not easy, and just kind of helping people understand that the company is in a much better place than it was compared to last year, and the stock price is down because of the very fact the markets are a voting machine. And I think that kind of is stuck, with most long-term investors to better understand that short-term anything can really happen. Okay, so NP, what is a good percentage of portfolio in liquid cash based on the current market? So I feel comfortable. It's going to be different for everyone, but I feel comfortable at around 15 to 20% at the moment. And will continue to increase as the market goes up. So for me, like the cash and markets are kind of move in the same direction. As they go up, my cash exposure goes up. As they go down, my cash exposure goes down. So they kind of move in tandem with each other. Okay, so let's see. Do you take the valuation of the market into consideration when you look at these frameworks? I mean, this might make sense if the S&P is at 20, maybe not 26. Yes. So we look at that every time. I've got a spreadsheet. I've got so many spreadsheets, but here's another one to show you and help you better understand the current market valuation, something that we have discussed in our previous videos as well. So let me see if this is, no, actually we've got S&P 500 PE. Or something that's labeled differently. Let me just see if I can find it. S&P 500. There we go. I did find it and it's gone. There we go. So that's the spreadsheet that we have that essentially goes over the historical price earnings multiple, where we are currently, where does that put us from a perspective of historical, different values, and then of course the different earnings per share, where we would be for that valuation. So we look at that as well. Anyway, so coming back over to the markets, we got QQQs up over 32 basis points. Then we've got S&P 500 to SPY up over 20 basis points. Tesla's flat, Nvidia's flat. So Sinu, thanks Karthik. What do you for what you do for the bundle FA, TA plus options? Do we get alerts as well? So alerts, Sinu, are going to be through Patreon. So that is more of a subscription. That's a little bit different. Courses are more of a one-time thing. You buy them, you get lifetime access to all the tutorials and all the additional tutorials that I continue to post. So those are two very different things. One is geared more towards your education, and the other one is more towards your daily engagement with the community and of course with other members. So the options, the fundamental, technical psychology, everything is a lifetime access, one-time thing. And then the Discord and Patreon is more like a recurring basis. Could you do an options course after the macros, kind of when and why the situation? Thanks for all the recent info. Course after the macros. So Jeremy, I do already have an options tutorial course, and then I'm actually planning on doing one on volatility, and then maybe another one on macros as well. But I feel like volatility is very misunderstood, or less understood, I should say, because volatility has a lot of answers for traders and investors. It has a lot of answers. I mean, something as simple as the VIX terms structure, which you can find on VIX Central. You can actually go there and see that for yourself on what's the current VIX terms future structure. You'll notice that this is the current structure, and we've got M1, M2, M3, M4, M5, M6, M7, and M8. Those are all the future months of volatility and how it's priced. This has a lot of information. Like, for example, the difference between M1 and M2 in itself is going to also tell us a lot about the overall market volatility and what they're pricing in. The overall shape of the curve, the different angles, the different pricing, all that has a lot of information for traders and investors. And this is one of the many indicators to look at. Then we also look at percentiles. We look at different data, how many average days volatility spent at these levels, how high does it go to, how low does it go to, like all those different things. I think very, very important stuff. No love for SMCI. Let's take a look at Super Micro. I mean, I used to love that stock. I mean, I feel we were one of the first ones to talk about SMCI 2 years ago, before it actually started going, because there was a huge potential for multiple expansion and the company's earnings were expected to increase by triple digits. Topped out at over almost $1,200, and it's now starting to come down. And we talked about SMCI, kind of stay away from that stock. Multiple times I've done videos on why I think it's important to avoid SMCI, unfortunately, because of the valuation risk. Let me see if I can come up with yeah, no, we've talked about this stock many times before on the channel, and why I think it's got a little bit ahead of itself in terms of its valuation and everything else. Anyway, so a couple more minutes for the markets to open here. We got QQQ still pushing higher. Tesla's now back lower, down about 0.5%. 10 for split coming up for SMCI, correct, Kim? That is going to be coming in, and that doesn't really change the fact of the valuation or anything else, but of course it does play a role in the overall sentiment for the company. So, we have SMCI as part of our shopping list, 37 stocks and ETFs. I've posted this in our Discord, but my fair value and of course my light buys are much, much lower. I believe in the 300s compared to where it's trading at the moment. So at one point, SMCI is going to start becoming more attractive once again. And the idea is that everything, if given to you at a good price, is worth investing in. Remember that for life, because price is what matters most for your long-term returns. Price paid determines your future returns, quite literally. You can have the most amazing asset, the most amazing, let's say a simple example, you can have the most amazing house that you want to buy, your dream house, and it is the best house on the street, and at the same time, it is priced twice or 3 times higher than its comparables. If you overpay, it doesn't matter how great that house is, you're just not going to make any money long term. But at the same time, if you buy a average house, but you underpay, you're paying significant discount, you're getting a great deal, you can still make money. So price paid determines your future returns in most circumstances, because at the end of the day, we're really expecting someone else to come around and of course pay a higher price for it. So if you're the one paying the higher price, then nobody else can. Okay, so markets are open. Volatility is still in the low 20s here. We're seeing the markets, of course, start off with a nice little green. Let's take a look at Max 7 here. Most of them are up. Nvidia's up over 2.2%. Then we got a lot of individual stocks starting off with a nice green start to the day. Palantir's up to $30.52, up over 1.7%. And then we got Zim Integrated, Robinhood, Starbucks, all pushing higher. Lemonade is up. FNGU's up to 346. I'm really contemplating getting rid of FNGU here and taking profits, because my gut tells me a little bit about this sell-off may not be over. But again, we'll find out soon enough. And this is the NASDAQ here, starting to bounce right back up, pushing up a little bit over close to 1% on the day so far. 33 basis points higher. Tesla, look at that sell-off here, down over 1% already. Continues to break down. So fair value of CMG, Sudeep. So if you come over, let's just quickly do that on our MoneyVest platform. It has come down, so that's good. We've got an M score of 3.74. That's fantastic. Analysts are pricing in for earnings growth of over 19 to 20%. If you come over to MoneyVest metrics, let's go over to the last 7 years worth of valuation. CMG is almost always traded at a pretty expensive valuation. So you'll notice the average is 116. That is very expensive. 2023, 51, 42, 75, 109. So it has traded at very, very high multiples in the past. And then we're looking at a 4P multiple of 48. So we got 19 to 20% growth with a 48 times P multiple. So let's just calculate the intrinsic value here. Let's grow the company by 20% and give them a, 25 or 30 times multiple. Let's just go with 30. Calculate. And we're still 37% overvalued. $34 ends up being the fair value for the company. This is purely based on math. I can make the company look undervalued as well if I go with 30% growth rate and a 40 times P multiple. Now you'll notice the company is actually undervalued by 24%. So it's purely based on math. You can make the company look undervalued, overvalued, whatever you want based on this calculator. But the idea then again, you got to ask yourself is how probable is a 30% growth rate and a 40 times P multiple for Chipotle? I love Chipotle. Every time I'm in the US, I love Chipotle. I go there at least once a week. So, it's an amazing company. I would argue that it's a little bit overpriced for the portions. I think there was a recent catalyst that Chipotle has been selling off of is the portions. I think the CEO or somebody said that the company is going to be fixing their portion sizes because they've been very questionable for the price that they pay you, price that you pay, and for the portions that you get. That's been one of the reasons I feel like it's been selling off. I read something about that, 29% down from its all-time high. So I think for me, 20% growth rate and 25 times P multiple would be more appropriate, putting the company down, definitely 37, 40, 45% lower than where it's trading at the moment. Milan says price is everything. Every price is so high. That's why Buffett is out. So, yeah, there's got to be a reason for him to not seeing any value in these markets, right? That's why he's better off sitting in T-bills than in the markets and deploying in the markets. So it makes sense. According to his multiples and different models and analysis, nothing makes sense right now. So Qdoba is good. In fact, it's actually funny. The first ever restaurant that I ever went to in the US was Qdoba. I remember landing, not the first ever restaurant not in the US per se. Like I've been there when I was a kid, so I don't really remember. But when I moved there for the first time, for many years, the first restaurant that my uncle took me to was Qdoba, Mexican restaurant, and I was like, where are we here? Like I wasn't really used to the Mexican food, but we went to Qdoba. Sleep says started preferring Kava over CMG for the food, not the stock. Different food, but the same styles. Yes, I think Kava is very similar as well, right? Mexican food, and you've got the same layout. So that's where we are. Palantir up to over $31 now. Absolutely incredible. Looks like we're going to have our third streak of green day in a row. So incredible gain on the day for Palantir at the moment. Nvidia pushing up very nicely. FNG up to 349. 349 is where we're at, 1.2% higher. 258, it's up over 35%. SOXL, I'm assuming, is also up very nicely. So up over 1.9%. SOXL from its Monday lows, it's up a little bit over 34%. And that's why I think it's important, when the volatility is high, when markets are trading down, risk rewards are very good. I think leveraged ETFs make more sense than your non-regular counterparts, because not saying that you can't trade QQQs. From Monday morning last week, QQQs are up a little bit over 6.5%, which is good. It's very good. But then, of course, the leveraged counterparts are up like 30 to 40%. That's why it makes a little bit more sense when risk rewards are really good. They're getting very favorable. Markets are down. it makes sense to be trading leverage ETFs. Again, not pushing anybody over there because it is a very risky market altogether. So you really have to be very precise, very careful with how you structure your trades, because once you are down, it becomes a big battle to come back out of those trades. So gotta do them very, very carefully, very precisely, where you want to be heavier versus where you want to be doing like some light buys. So for FNGU, I was down, when I first initiated that trade, but then Monday morning is when I did heavy buying. And now, of course, back in the green very nicely. So I'm actually planning on holding that trade because I don't fully trust this rally yet. I feel like there is potential for some more downside. Anyway, so thank you so much for joining, everyone. I really appreciate all of you. Make sure that you drop a like and subscribe to the channel if you haven't already. Share this live stream, share these videos with your family, friends, other members, investors, traders, so that we can continue to grow our community, engage with other investors and traders as well. So again, thank you so much for joining. Link's going to be down below if you want to take advantage of our Discord, our Patreon, our courses. Everything's going to be down below. And as always, happy investing. I'll see you all in the next live stream. I'm going to spend some time in Discord. If you have any questions, feel free to reach out over there. Thank you.